Viewers at home, you are welcome to my presentation on control accounts. In this presentation, I will give the general overview of control accounts, the importance of control accounts. Number one, general overview of control accounts, the importance of control accounts, the types of control accounts, the format of control accounts. Then I will also solve questions as work example. If this is your first time of coming across my channel, or if you have not subscribed in the past, please hit the red subscribe button and turn on the notification bell icon so that you'll be able to receive a notification message each time I drop a new video. If you are a returning subscriber, I say thank you and God bless you. What is control accounts? Control accounts is the memorandum accounts into which shall be recorded the total of the debit and credit balances extracted from the individual ledgers. The memorandum accounts into which shall be recorded the total of the debit and credit balances extracted from the individual ledgers. Control account can also be called the total accounts. It can also be called the total accounts because it serves as a check on individual ledgers. Control account can also be called the total accounts because it serves as a check on individual ledgers. Importance of control accounts. Importance of control accounts. Importance of control accounts. Number one, control accounts serves as a proof of the arithmetic accuracy of the individual ledgers. It serves as a proof of the arithmetic accuracy of the individual ledgers. Control account serves as a proof of the arithmetic accuracy of the individual ledgers. It helps to locate errors when the trial balance does not agree. Control accounts helps to locate errors when the trial balance does not agree. It helps to locate error when the trial balance does not agree. Number three, control account helps to minimize fraud. It helps to minimize fraud. It helps to minimize fraud. Number four, control accounts helps in the preparation of interim financial statements. It helps in the preparation of interim financial statements. Control account helps in the preparation of interim financial statements. These are the importance of control account. Number one, importance of control account is that it serves as a proof of the arithmetic accuracy of the individual ledgers. Number 2, it helps to locate errors when the trial balance fails to agree. It helps to locate error when the trial balance fails to agree, or when the trial balance does not agree. Number 3, it helps to minimize fraud. And finally, it helps in the preparation of interim financial statements. These are the importance of control accounts. So, types of control accounts. Types of control accounts. There are 2 types of control accounts. Types of control accounts. There are 2 types of control account we are going to consider. Number 1, we have receivable ledger control account. Receivable ledger control account. Control account. And the number 2, we have the payable ledger control account. Another word for the receivable ledger control account is sales ledger control account or revenue ledger control account. While another word for payable ledger control account is the purchase ledger control account. So I want to start with the sales ledger control account or the receivable ledger control account. Receivable ledger control accounts. Receivable ledger control accounts. So what do we mean by the receivable ledger control account? Receivable ledger control accounts records the transaction that affect the customers. It records all the transactions that have to do with the business customers. All transactions that have to do with the customers will be recorded in this account. Examples of those transactions that will be recorded in the receivable ledger control accounts are: number 1, we have credit revenue. Credit revenue or credit sales. Or credit sales. Number 2, we have cash or check received from customers. Cash or check received from customers. I've told you that the transactions that affect the business customers are those transactions that will be recorded in the receivable or sales ledger control account. Number 3, we have the discount allowed. The discount allowed. Discount allowed. Number 4, we have the cash or check refunded. Cash or check refunded. Cash or check refunded. The next one, we have the carriage outwards. Carriage outwards. Carriage outwards. Then we also have the interest charged. Interest charged. These are the items that will be recorded in the control account. Then we also have the return inwards. Return inwards. Return inwards. Then we also have bills receivables. Bills receivables accepted. Bills receivables accepted. Then we also have the bad debts written off. Bad debts written off. Then we also have the customer's check dishonored. Customers check dishonored. Then you may also have Then we have the debit note issued. Debit note issued. Then we also have the credit note issued. Credit note issued. Then you may also have discount allowed, non-disallowed. Discount allowed, non-disallowed. Then you may also have the service charge. Service charge. You may also have the interest charge, if not yet considered. Interest charge on overdue account. Interest, okay, I've written interest. Interest charge on overdue account. Then you may also have the set off. Set off. Set off. The amount set off. These are the examples of items that will be recorded in the receivable ledger control account. Items that will be recorded in the receivable or the sales ledger control account include the credit revenue or credit sales, the cash or check received from customers. We have the discount allowed. We have the cash or check refunded. We have the carriage outwards. We have interest charged. We have return inwards. We have bills receivables accepted. Then in some question, you may be given both the bills receivables and the bills receivables accepted. Where you are given the bills receivables and bills receivables accepted, then it is only the bills receivables accepted that will be recorded, and the bills receivables should be ignored. But where you are given only the bills receivable in the question and there is no bills receivables accepted, that means the bills receivable will be assumed to be accepted. Therefore, you are going to record that. Then we have bad debts written off. We have the customer's check dishonored. We have the debit note issued, the one issued to customers, and the credit note issued to customers. So we may have debit note received and credit note received. That one affects the suppliers. So those ones will be recorded in the payable ledger control accounts. Then we have the discount allowed, non-disallowed. Then we also have the service charge, and then the set off. What do you mean by set off? Set off arises where you use the debit balance in one personal account to settle the credit balance in another personal or individual account. That means if you have a debit balance in receivable ledger, you use it to settle the credit balance in the payable ledger. That is a set off. Set off is usually treated as a contra entry. It is usually treated as a contra entry. Now, I want to talk about the format of receivable ledger control account. Before I give you the format, I want you to take note of this. What are those items that will be recorded at the debit side? How do you know those items without memorizing them? And how do you know the items that will appear at the credit side of the receivable ledger control account without memorizing them? So now your receivable ledger control account, receivable ledger control account. Receivable ledger control account. At the debit side, what are those items that will appear at the debit side? This is the debit side. Remember, the left hand side of an account is the debit side, while the right hand side is the credit side. What are those items that will appear at the debit side? Debit items that will increase the debt of the customers. Items, debit the item. Debit the items that will increase the debt of the customers. Increase the debt of the customers. That is, if customers were owing $1 million before. What are the items that will make that debt to increase? That is, items that increase it. Increase items that will increase the debt. That is, items that will increase the amount the customers are owing. Credit item that reduces the debt of the customers. Credit items that reduces the debt of the customers. Item that reduces the debt of the customers, you credit them. That is item. Decrease items. Item that decreases the debt. That will make the amount the customers were owing to reduce. Where that item will reduce the amount the customers were previously owing, you credit them. But where it will lead to increase, you debit them. Let's look at the items listed earlier. Now, let's look at the items we have listed. Now, where there are credit revenue or credit sales, that means you sell some goods on credit. If customers were owing, you make further sales and you have not collected money, that means the amount the customer were owing will increase. Since it will increase, you debit it. That means you are going to debit the credit revenue. Cash received from customers. Part of the amount the customers were owing have now been paid by that customers. The part of the amount the customers were owing have now been paid by the customers. Then you have the cash received from customers. I've told you that the credit revenue should be debited. The cash received from customer, since the cash was received, part of what they were owing have been paid by the customer. That means the amount the customer were owing will reduce. So you are going to credit it. Then discount allowed. When you give discount to customers, that will reduce the amount the customer is supposed to pay. So you credit it. Cash or check refunded. Cash or check refunded by customers. So this will lead to an increase. So you debit it. Then carriage outwards. When you sell goods to customers and the customer incurs some amount in transportation, in carrying the goods out, the carriage outwards will increase the value of the goods. When you incur, maybe you sell goods worth 1,000 and you transport them to customer with 1,000. If you sell the goods for $20,000 and you use $1,000 to transport it, the carriage cost, the cost of that transportation have to form part of the value of that item. That means you are going to add it to the purchase price or the sales price of the item. So that means the value now increased from 20,000 to 21,000. So carriage outward will lead to an increase in the amount the customers were owing. So you debit it. Interest charge. When you charge customers interest for not making an immediate payment, that means the amount the customers are owing, which will be paid in future, will increase. So you debit the interest charge. Returning was, after sales, the customer return part of the goods to you. So this will lead to reduction in the amount they were owing since that goods have been returned. So since it leads to reduction, you debit it. Then bills receivables accepted. Bills receivable also leads to reduction, so you credit it. Bad debts, where some debts owed by the customer are irrecoverable, where those debts cannot be recovered. So the bad debts, so that means the amount the customers are owing will reduce, so you credit it. Then customer check dishonored, where certain checks were dishonored. So the amount the customers are owing will increase. So you debit the check dishonored. Debit note yield. Debit note yield. So where you issue a debit note to customers, that means you have debited the customer's account. Maybe the amount the customer have paid earlier is not up to what they ought to have paid, or maybe there was a miscalculation. So in the total, so the amount was undercast, and you later discover maybe the amount supposed to be $20,000 and you mistakenly added it to be $19,000. That means you are owing the customer, you are assuming that the customer is still owing 1,000. You send a debit note to the customers. So in that case, the debit note, that means the amount the customer were owing will increase. So you debit the debit note issued. The credit note issued, that means you have credited the customer's account. By issuing the credit note to customers, you have credited their account. Maybe they overpay. So when you credit the account of the customers, that means you assume that the customers, the amount they were owing has reduced. So this will lead to reduction in the amount the customers were owing. Discount allowed, now disallowed. It was given to customer before. It was allowed, and when it was allowed, the amount the customers were owing was previously reduced. But when you now disallow it, that means you no longer grant that discount. So that means the amount the customers were owing will now increase. So you debit it. Service charge, when you charge the customer for service you render. So this service charge will lead to an increase in the amount the customers were owing. So you debit the service charge. The setup depends on whether it is a debit balance or a credit balance you want to set up against other. So by the time I'm giving you the format, then I will explain how that will be treated. It may appear as a debit, you may debit it, and it may appear as a credit depending on the wording used in the question. So now let's have the comprehensive format. So format of receivable ledger control account. So the name of the entity, let's say you have XYZ as the name of the entity. Control accounts. The period have to be specified. So you have to indicate the type of control accounts. So receivable ledger control accounts. Receivable ledger control accounts. This is the debit side and this is the credit side. The first thing is the balance, your receivable ledger balance. And sometimes you'll be told, you'll be given receivable ledger balance and the question will be silent. You will not be told whether it is a debit balance or a credit balance. Where you are not told whether that balance is a debit or credit balance, you should know that the receivable ledger balance must be a debit balance. So you may have balance brought forward. So you know it is a debit balance. And where you are told it is debit balance, you put it at the debit side. That is the opening balance. But where it is credit balance, it has to be specified. Balance brought forward or brought down. Credit balance. Where it is credit balance, I've told you it will be stated. That is for the sales ledger balance. Where it is credit balance, you put it at the credit side. But where it is debit side, a balance, you put it at the debit side. And where the examiner is silent about it, you know that it will have a debit balance. Now, let's look at those items listed. Credit revenue or credit sales. We said this will lead to an increase in the amount the customers are owing. I've told you that item that leads to an increase, you put them at the debit side. So we have credit revenue or credit sales at the debit side. Then the next item is cash or check receipt from customers. When customers pay part of what they are owing, the amount the customers are owing previously will reduce. So you credit it. Cash or check received from customers. Cash or check received from customers. You credit it. Then you have discount allowed, where you give customer discount. That means the amount they ought to pay will reduce. So you credit it. Discount allowed. Since it leads to reduction, that is why you are crediting it. After discount allowed, you have cash refunded. Cash refunded. I've told you that this will lead to an increase in the customer's indebtedness. Cash refunded. You debit it. After cash refunded, we have carriage outwards. The cost of transporting the goods to customers, you have to add it to the amount you sell it. Carriage outwards, and this will lead to an increase in the amount the customers ought to have paid. So that is why we debit it. After carriage outward, we have interest charge. Since the customers are not paying immediately, they are purchasing the goods on credit. So the interest, you charge them interest. Interest charge on overdue account, interest charge, leading to an increase in the amount they will pay. So you debit it. Then we have return inwards. Return inwards, when customer return part of the goods to you. That means if they were owing you $20,000 before and they return goods worth $5,000, that means the amount they are owing becomes $15,000. Return inwards leads to the reduction. Return inwards, so you credit it since it reduces their indebtedness. Then we have bills receivables accepted. Bills receivables, so reduces the amount the customers are owing. Bills receivables, I've told you that it is the accepted one that have to be recorded, but where you are given only bills receivable in the question, it is assumed that that bills receivable is accepted, so it will be recorded. But where you are given bills receivable separate and the bills receivable accepted, you only record the one accepted. Then we have the bad debts written off. Bad debts written off. Bad debts written off. You don't record the provision for bad debts in your control account. Where you are given the provision for bad or doubtful debts, you ignore it. So we have after bad debts, you have customer check dishonored. Customer check dishonored increases the customer's indebtedness. Dishonored check. So since it increases it, so you debit it. Then we also have debit note issued. When you issue a credit note, a debit note to customers, that means you are debiting the customer's account because the customer, you just discover certain amount which was understated in the amount the customers were owing, and you are now debiting the customer's account further, and that means the customer's debt will increase when you debit the accounts of the customers. So debit note issued. Debit note issued. But if you have debit note received, that will appear in the supplier's account. You use the debit note issued in the receivable, in the payable ledger control account. So then we have credit note issued. The credit note issue. When you issue a credit note, that means you are crediting the accounts of the customers. Their indebtedness reduces. So credit note issued. So you credit your receivable ledger control account. Then you also have discount allowed, now disallowed. But I want, mind you, if you have debit note received, I've told you that that will appear in the payable ledger control account. If you have credit note received also, it will appear in the payable ledger control account. So discount allowed, non-disallowed. Remember your discount allowed, you have credited it. So when you disallow it now, you are going to debit it. Disallowed discount. Disallowed discount. Then you have service charge. When you charge customers for the service you render, that means you are increasing the amount the customers ought to pay. So we have service charge. So you debit it. Then you have set off. Where you have a debit balance, set off. Debit balance. I've told you that normally your receivable ledger control account will have a debit balance. So where this debit balance, where you have debit balance, that means the debit side exceeds the credit side. Where the debit balance is set off against the credit balance of purchases, that means you are going to credit it. Set off. That is debit balance in receivable ledger. Debit balance in receivable ledger. Debit balance in receivable ledger set off against credit balance in payable ledger. No, this is debit balance in receivable ledger. You set it off against the credit balance in payable ledger. But if it is credit balance in receivable ledger, you want to set off against the debit balance in payable ledger, you have set off here. That is, this is credit balance in receivable ledger, credit balance in receivable ledger set off against the debit balance in receivable ledger. Please take note of that, of the wording of the question, whether it is a debit balance, whether it is debit balance in receivables setting off against the credit balance in payable. I've told you that where you have debit balance in receivables set off against credit balance, so you put it at the credit side, and where it is credit balance in receivable ledger that was set off against the debit balance in payable ledger, so you debit it. At the end of the period, you are going to have the closing balance. Normally your receivable ledger will have a debit balance, so your closing balance, that is where it is debit balance, sometimes you may be given, and where it is not given, that means the difference between the two sides is what will give you that balance. And where it is credit balance, you put it at the debit side. This is credit balance, I mean the closing balance now. So at the end of the period, you find the total, then it must agree. Balance brought down. What was carried down here is that will be brought down here, and what was carried down to the debit side here, which is the closing balance here, you are going to bring it down as an opening balance for the next period. That is the format for preparing the receivable and payable ledger. For preparing the receivable ledger control accounts. That is the format for preparing the receivable ledger control accounts. I want to solve question as a work example. I want to give a work example to explain the various concepts we have discussed. So, example now. Example. The following balances appears in the books of Ismail Limited on 1st of January 22X. You are given the receivable balance. They just give you the receivable balance. We're not being told whether it is a debit or credit balance. You should know that this balance is a debit balance, where the examiner is silent like that. Since it is a debit balance, you are going to bring it down to the debit side of the receivable ledger control account. Then you also have credit balance in receivable ledger. Since this is given to be the credit balance, so you are going to brought it down to the credit side of the receivable ledger control accounts. The following transaction took place during the month. You have the return inwards 840. Return inwards, when customer return goods, that means the customer's debt reduces, so you credit it. Bad debts written off, where there are bad debts, you assume that the amount the customers are owing has reduced because you cannot recover that amount. You may not recover it, you may not be able to recover it. So you credit it since it leads to reduction in customers' debt. Discount allowed. When you give customer discount, the amount the customers ought to pay reduces, so you credit it. Cash receipt from customers also reduce the amount the customers were previously owing. Bills receivable leads to reduction as well. But you are equally given bills receivables accepted. I've told you that where you are given both the bills receivables and bills receivables accepted, you only record the bills receivable accepted, while bills receivable should be ignored. Then customer check dishonored. This will lead to increase in the customer's debt. So you debit it. Balance on sales ledger set off against balance in purchases ledger, or balance in receivable ledger set off against the balance in purchases ledger. This is a setup, and we're not being told whether it is a debit balance or credit balance. You should know that your receivable ledger control account will have a debit balance, so you should know that it is a balance. Since it is balance in sales ledger, that means it is receivable ledger debit balance. You want to set off against the credit balance in payables ledger, because under normal circumstances the payable ledger will have a credit balance. So carriage outwards cost of transporting the goods to customers, which you will ordinarily add to the selling price of the goods. So that when you add it to it, that means the customer's debt increases by that amount. Then service charge added to unpaid account. You charge the customer for your service. When you charge the customer for service, the customer debt increases. So you debit that. Then credit revenue. That means you sell goods to customers on credit, which will also lead to an increase in the customer's debt. So you debit it. Receivable ledger debit balance. This is the closing balance. So this is the closing balance. So you are going to brought it down to the credit. You carry it down to the credit side. And receivable ledger debit balance. This is the closing balance as well. So since it is credit balance, we are going to bring it down to the debit side. So take note of that. You are required to prepare the receivable ledger control accounts for the period. Now, let's have the solution. We want to prepare the receivable ledger control account. So, solution. So, the solution, we have the receivable ledger control accounts. So you have the debit and the credit side. So you are given the opening balance. The question says receivable ledger balance. I've told you that this balance is a debit balance. Where the examiner is silent, you know it is the debit balance. The debit balance will be brought down. You either brought it forward or brought it down to the debit side, which is 14,581. You also have credit balance in receivable ledger. Credit balance in receivable ledger, and that is given to be 902 and 1,902. 1,902. You brought it down to the credit side, balance brought down, or you may write balance brought forward. 1,902. These are the opening balances. You now go to the detailed transaction. You were told the following transactions took place during the month. Those are the detailed transactions during the month. You have the returning was. We said that will lead to reduction in customers' debt. So you are going to record it at the credit side. Return inwards of 840. Then you also have bad debts written off of 627, which will also lead to reduction in customers' debt. Bad debts written off, and that is 627. Then the next item is discount allowed, which is 1593. Discount allowed also reduces customers' debt. Discount allowed of 1593. 1593. Then you also have cash received from customers of 32,706, which will also reduces customers' debt. 32,706 cash received from customers, 32,706. So you credit it because it leads to reduction in customers' debt. Then we also have bills receivables. I've told you that where both the bills receivables and bills receivables accepted are given, bills receivable should be ignored while you record only the bills receivable accepted. But where only bills receivable is given in the question and there is no bills receivable accepted, then you record that bills receivable. So the bills receivable accepted, bills, that also reduces customer debt. Bills receivable accepted, and that amounted to 8,351. 8,351. 8,351. Then the next item is customer's check dishonored of 15,000. That increases the customer's debt. Dishonored check. So since it increases the customer's debt, you debit it. Dishonored check. That is 15,000. Then balance. The next item is balance on sales ledger. On sales ledger, set off against balance in purchase ledger. We have set off of 1,498. Since you were not being told whether it is a debit or credit balance in sales ledger, you know that it is a debit balance. So a debit balance, you are going to put it at the credit side. So we have set off. Set off. And that amounted to 1,498. Then the next item, we have carriage outwards. Carriage outwards of 4,000. That will increase the customer's debt. So because you are going to add it to the sales price of the item, so you debit it. Carriage outwards of 4,000. Then the next item is service charge added to unpaid accounts. That is 3,000. Service charge added to unpaid account. When you charge the customers for your service, that increases the customer's debt. So we have service charge, and that is 3,000. So you debit it. Then the next item is credit revenue, where you sell to customers on credit. So customer debt increases, so you debit it. Credit revenue, and that amounted to 40,000. That is credit revenue. Then you have receivable ledger debit balance. This is the closing balance. The closing balance, since it is a debit balance, you are going to bring it down to the debit side. That is 31,000. So we have balance brought down. Balance carried down. 31,000. Then the last item, you have receivable ledger credit balance, which is 1,936. You have been told that one is credit balance. So since it is credit balance, at the debit side, you have balance carried down. 1,936. So, since everything have been posted accordingly, the next thing is to cast. That is, you add up the debit side in order to ascertain the total of the debit side. Then you also add up the credit side in order to ascertain the total of the credit side. So 14,000, the debit side, now I'm adding 14,581 plus 15,000 plus 4,000 plus 3,000 plus 40,000 plus 1,936. Then the total is 78,517. 78,517. Now the credit side now, you have 1,902, you have 840, then we have 627, we have 1,593, we have 32,706, we have 8,351, we have 1,498, and then we have 31,000. The total is 78,517. The closing balance here will be brought down to the credit side. Balance brought down, which is 1,936. The closing balance here will also be brought down. Balance brought down, which is 31,000. In some cases, you will not be given the closing balance here. So where the closing balance is not given, by the time you sum up the debit side, the total of the debit side will exceed the total of the credit side here. The difference between the two sides will now be the closing balance here. That is the receivable ledger control account. Part 2 of my presentation shall cover, part 2 of my presentation on control account shall cover the payable or purchases ledger control accounts. Thanks.